Stuyvesant Town and Peter Cooper Village occupy 80 acres of Manhattan's East Side, between 14th Street and 23rd Street, a complex of brick residential towers built by MetLife between 1943 and 1947 as affordable housing for returning World War II veterans. The complex contains approximately 11,000 apartments across 89 buildings. It is the largest residential development in Manhattan. It has housed more than 100,000 New Yorkers across 3 generations. In 2006, Tishman Speyer Properties and BlackRock Realty acquired Stuyvesant Town and Peter Cooper Village from MetLife for $5.4 billion, the largest single real estate transaction in American history at the time of its closing. In January 2010, Tishman Speyer and BlackRock defaulted on the property's mortgage. The default was the largest residential real estate default in the history of the United States. The forensic entry point for this case is the gap between what Stuyvesant Town was when MetLife sold it and what Tishman Speyer needed it to become in order to service the debt the acquisition had required. That gap was not a planning error or an execution failure. It was a legal and political impossibility that the acquisition's financial model had treated as a manageable risk. MetLife had operated Stuyvesant Town as a rent-stabilized complex for more than 60 years. The apartments were occupied by long-term tenants whose rents were governed by New York State's rent stabilization laws, which limited annual rent increases to amounts set by the New York City Rent Guidelines Board. Those rents were significantly below the market rates that the same apartments would command if they were deregulated and rented at prices the Manhattan housing market would support. The $5.4 billion acquisition price required the apartments to generate market-rate rents. The rent stabilization laws prevented the apartments from generating market-rate rents. The acquisition model required Stuyvesant Town's tenant base to be progressively converted from rent-stabilized long-term residents to market-rate-paying new tenants at a pace that the legal conversion mechanisms permitted. Those mechanisms proved slower, more expensive, and more legally contested than the model had assumed. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The financing structure for the Tishman Speyer and BlackRock acquisition was assembled through a combination of equity from the buyers and their co-investors and approximately $3 billion in commercial mortgage-backed securities, a debt instrument whose characteristics made the Stuyvesant Town default particularly consequential for the broader CMBS market. The CMBS structure required the debt to be packaged and sold to institutional investors in tranches of varying risk and return profiles. The senior tranches were rated investment grade by the major rating agencies, whose assessment of the debt's safety was based on the cash flow projections that Tishman Speyer and BlackRock had provided, and that the rating agencies had accepted without adequate independent verification of the regulatory constraints that governed the revenue those cash flows depended on. The covenant that nobody in the CMBS underwriting chain read carefully enough was the one written into New York State's tenant protection laws. The acquisition model projected a conversion of rent-stabilized apartments to market-rate apartments at a pace that assumed the legal mechanisms for deregulation, primarily the vacancy decontrol provisions that allowed apartments to be removed from rent stabilization when the monthly rent exceeded a statutory threshold upon tenant turnover, would operate at a rate sufficient to generate the revenue growth the debt service required. The legal constraint on that conversion rate was not hidden. It was documented in the rent stabilization statutes that governed every apartment in the complex. The rate of natural tenant turnover in a complex occupied by long-term residents with below-market rents is significantly lower than the rate assumed in a financial model designed to convert those residents to market-rate tenants as quickly as legally possible. Long-term tenants with rents 40 to 60% below market have no financial incentive to leave voluntarily. The vacancy decontrol mechanism requires vacancy. Vacancy requires departure. Departure was not occurring at the rate the model required. The gap between the projected conversion rate and the actual conversion rate produced a revenue shortfall that emerged within the first year of the acquisition and widened progressively as the debt service clock advanced, without the revenue growth that the conversion rate had been expected to generate. At what point does a financial model's treatment of a statutory constraint as a manageable risk become institutional negligence? Leave your analysis in the comments below. The appraisal methodology applied to Stuyvesant Town's 2006 acquisition produced a stabilized value of $5.4 billion on the basis of a revenue projection that required approximately half of the complex's 11,000 apartments to be converted from rent-stabilized to market-rate status within 10 years of the acquisition. That projection was not grounded in the empirical conversion rate that comparable rent-stabilized complexes had achieved in New York City over the preceding decade. It was grounded in the maximum conversion rate that the vacancy decontrol mechanism could theoretically produce if every apartment that became vacant was successfully deregulated and re-rented at market rates, and if tenant turnover occurred at the pace that the model's demographic assumptions projected. The empirical conversion rate was substantially lower than the theoretical maximum. The specific legal development that most severely compromised the acquisition model was not the failure of the conversion rate to reach the projected pace, though that failure alone would have produced the default. It was a 2009 court ruling in the case of Roberts v. Tishman Speyer Properties, in which the New York Court of Appeals determined that the owners had improperly removed apartments from rent stabilization while receiving tax benefits under the J51 program, a New York City tax incentive for residential renovation. The ruling required the illegal deregulated apartments to be returned to rent-stabilized status and made the tenants who had been charged market-rate rents eligible for rent overcharge claims. The Roberts ruling eliminated a significant portion of the market-rate revenue that the acquisition model had treated as already achieved, reducing the complex's actual net operating income to a level materially below what the debt service required. The appraisal had not priced the J51 legal risk because the risk had not been widely recognized as legally significant at the time of the acquisition. The rating agencies had not priced it. The CMBS investors had not priced it. The sellers, MetLife, had not disclosed it as a material risk factor. It was, in the forensic framework of this channel, an unpriced liability of a specific and recurring type, a regulatory constraint whose implications became apparent only after the capital had been committed. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. Tishman Speyer's management of Stuyvesant Town between 2006 and the 2010 default produced a documented record of tenant relations that became a separate forensic subject from the financial analysis of the acquisition. The ownership's effort to accelerate apartment conversions through aggressive enforcement of lease terms, targeted renovation programs in vacant apartments, and legal challenges to tenant occupancy arrangements that the previous ownership had tolerated generated a sustained political and media response that complicated the ownership's regulatory relationships and its ability to pursue the conversion strategy that the debt service required. The Tenant Association at Stuyvesant Town, one of the most organized and politically connected resident groups in New York City, mounted a sustained campaign against the conversion strategy that included the Roberts litigation, lobbying at the state and city level, and media coverage that kept the Stuyvesant Town situation in the public conversation throughout the ownership period. The institutional denial in this case is not the denial of a financial reality that the ownership refused to acknowledge. Tishman Speyer's internal communications, subsequently disclosed in the default proceedings, documented a clear-eyed recognition by 2008 that the conversion rate required to service the debt was not achievable within any realistic timeline. The denial was the decision to continue servicing the debt for 18 months after that recognition rather than to default immediately, a decision that consumed equity reserves that the default proceedings would eventually have distributed to junior creditors, and that preserved no recoverable value for the buyers who had made the equity investment. The default in January 2010 transferred the property to the creditors, who eventually sold it to a partnership led by Blackstone Group and Ivanhoe Cambridge in 2015 for approximately $5.3 billion. Almost exactly the price that Tishman Speyer had paid in 2006, suggesting that the underlying value of the asset had been approximately correct, and that the acquisition's financial model had been wrong not about the value, but about the mechanism for converting that value into cash flow. The Blackstone and Ivanhoe Cambridge acquisition of Stuyvesant Town in 2015 for approximately $5.3 billion was structured with a critical difference from the 2006 transaction. A binding agreement with New York City to preserve a minimum of 5,000 apartments as affordable housing for a period of 20 years, in exchange for city financing assistance that helped make the acquisition economics viable without requiring the market rate conversion pace that had destroyed the Tishman Speyer model. That agreement converted the regulatory constraint that had produced the 2010 default from a liability into a structured obligation with a defined scope and timeline, allowing the acquisition model to be sized to the actual affordable housing revenue rather than to the theoretical market rate revenue that the 2006 model had required. The outcome was financially sustainable in a way that the 2006 acquisition had not been, because the capital structure was sized to what the regulatory environment would actually produce, rather than to what the owners needed the regulatory environment to produce. What the Stuyvesant Town case reveals in the context of this channel's 24-case archive is the specific risk of an acquisition model that treats a statutory constraint as a conversion opportunity rather than as a fixed cost. Every previous case file has documented ownership groups that over-leveraged assets against cash flow projections that the market eventually failed to validate. The Stuyvesant Town case documents an ownership group that over-leveraged an asset against cash flow projections that the law had already determined were not achievable at the time of the acquisition by any ownership that chose to pursue them in the manner the financial model required. The 80 acres of Manhattan's East Side are still there. The brick towers are still there. The tenants, many of them the children and grandchildren of the veterans for whom MetLife built the complex in 1943, are still there. The rent stabilization laws are still there. The $5.4 billion acquisition model that failed to account for all of those permanencies is documented in the federal bankruptcy court filings that the default produced. The marble does not lie. In this case, the bricks did not either. If this case file changed how you evaluate the relationship between statutory constraints and acquisition models in regulated residential real estate, subscribe to this channel because the next case examines a building whose regulatory protection was designed to preserve it and instead became the mechanism of its financial destruction. And in the comments, given the Roberts Court ruling that retroactively eliminated apartments from the market rate conversion count, what specific legal due diligence standard would have identified the J51 regulatory risk before the $5.4 billion transaction closed? The case file is open.